Timbercreek Financial has been a reliable source of consistent dividends despite the economic weather. Can they maintain the status quo? Or, well, fasten your seatbelts, folks. This is going to be a good one. Timbercreek Financial, formed in 2016 through a merger of two companies under the Timbercreek Asset Management umbrella. They aimed to become a leading non-bank commercial real estate lender with a diversified portfolio and stronger capital markets presence, while also ending all prior management agreements with that umbrella company. Timber Creek quickly established themselves as a key player in Canada's real estate lending market. As a mortgage investment corporation, or MIC, they pool investor funds to provide mortgages primarily to commercial properties, paying out most of their income. Well, they pay out most of their income in dividends. Unlike real estate investment trusts or REITs, MICs, like Timber Creek, don't own property directly. Instead, they generate revenue from interest payments on their mortgage loans. However, both MICs and REITs offer significant dividend yields, appealing to investors who value regular income. With escalating U.S. trade tensions, potential recessionary pressures, and fluctuating interest rates, Timber Creek Financial's model presents both strengths and vulnerabilities. While lower interest rates may initially compress margins for lenders, their focus on short-term, higher-yield mortgages positions them well to navigate these challenging times, provided, of course, their defaults remain on the lower side. They do have an attractive dividend, and that means the question may be more about the sustainability of that dividend, as share prices will rebound. But, well, a dividend cut, that has more immediate pain for sure. A sub to the channel is the best way to avoid any cuts in future content. I do like to look at some of the reports, and the latest we have for Timber Creek is their 2024 annual report. As usual, I did find a few highlights that I wanted to share. So their net mortgage investment portfolio, it grew by $143.6 million in 2024. Taking it up to, well, 1.09 billion, and that's not too shabby. In addition, the company's manager achieved CMHC approved lender status. Now that's important because it enables them to provide term financing in addition to bridge loans. This opens new opportunities to deepen borrower relationships and, well, that grows revenue. Also, in the report, in terms of their dividend, they did have distributable income in 2024 at 64.9 million, that led to a payout ratio of 88.3%, which is absolutely very sustainable for sure. We will have to find out if that is still the case. I loved their report for sure, but words can only take us so far. I think we need to dive into their fundamentals. So you guys know, if there are numbers involved, we need to call on the Sultan of Sustainability, the Duke of Dividends, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current value is coming in at $6.66. So that's a little evil. Their market cap coming in at $549.52 million, and they have a fairly average beta of 1.17. Those earnings per share, 0.56, and their price to earnings ratio coming in at 11.82. The average amongst their peers is a little lower, 10.9. Now, some of those peers include MCAN Mortgage with a PE ratio of 9.2, Atrium Mortgage Investment with a 10.5, and Firm Capital Mortgage Investment coming in at 12.1. Looking at their price to book ratio, that's coming in at 0.80, and the average amongst those same peers, 1.70. Switching over to the return on equity, that's coming in at 6.65%. Those return on assets, 2.62%. For the most part, these numbers do look fine. You guys know, I would love to see the ROE a wee bit higher. Okay, let's dive a little deeper and take a look at their cash flow and fair value data. Their revenue comes in at $72.50 million per year. Those earnings, they're coming in at $46.16 million. Now, on the bright side, those earnings are projected to grow by 13.19% per year over their next 5 years. I do like that. I do like that. Their profit margin, I also like this number, 63.67%. Switching to their free cash flow, that is in the negative, coming in at negative $69.08 million. Operating cash flow, exact same number, negative 69.08 million. I do, of course, need to point out a negative cash flow is not automatically a bad thing. It may very well reflect strategic investments in loan growth or temporary mismatches in cash flows. And that is actually common in the lending industry. It is, though, something to watch as we move deeper into this year. So I'll keep my eye on that cash flow for sure. Let's look at their fair value. Once again, the current value coming in at $6.66 using a discounted cash flow model. We get a fair value of $11.41. That does paint them as being undervalued by 42.2%. And their 1-year target, that's coming in at $7.67. So that is an increase of 16.2% over the next year. I would certainly love to see that, and I do think that's very doable. This data, for the most part, does look okay. There is, of course, a slight pause at the negative cash flow, but as I mentioned earlier, it's not unusual in an MIC for sure. Okay, let's turn the page and dive into the returns data. Looking at their dividend, they have a yield of 10.455%, monthly dividend of 5.8 cents per share. Now, that payout ratio, it has gone up. We're looking at 123.21%. That is a huge jump from the 2024 value, and it certainly is enough to rise an eyebrow for sure. Now, when it comes to their 5-year average dividend increase, it's zero. Their dividend has been the same for a very long time. I do want to add that their dividends are considered 100% interest from Canadian sources, which, well, that means it's classified as income. For that reason, this is a stock ideal for holding in a registered account to avoid those taxes. Okay, let's look at their returns on their 3-year return on investment. Oh boy, negative 26.73%. Add in the dividends, we're still in the hole, negative 4.40%. Real estate had a rough time over the last 3 years with a bear market, aggressive rate hikes, all that fun. And this return shows that big time. Looking a little bit closer at our 1-year return, we're still in the negative 10.60%, adding in the dividends, total return negative 1.26%. Interestingly enough, in this time frame, real estate had a great run from June into the fall, but it has been less than stellar since, which helped to keep them in the negative. That 3-year annualized, once again, this is a story of negatives today, negative 1.49%. I do not like seeing negative total returns at all, and that is something I do have to take into consideration. Okay, let's take that last dive into their debt data. Their total debt is coming in at $962.92 million. Total equity, $686.60 million. That does give us a debt to equity ratio of 140.2%. Now, that debt to equity ratio, it has reduced a wee bit from 144.2% to 140.2% over their last 5 years. Also, when you're looking at a number like that, keep in mind that debt is, well, it is very normal for an MIC. They use that to run their business. Looking at their cash and cash equivalents, not a lot of help here, 14.09 million. Okay, let's look at their short term. They have assets of 1.7 billion, liabilities of 16.51 million. Holy banana bread. I kind of love that short-term data quite a bit. Now, their long-term, well, this one's another story completely. They have assets of 38.77 million and liabilities of 931.07 million. I'm not loving that a lot, but their short term really still has me excited. Overall, this debt is perfectly in line for an MIC. It is on the high side of normal, though. Of course, with that negative cash flow, their debt and the servicing of that debt is, of course, absolutely not well covered. Now, another good point is that in terms of share dilution, we've had none. I like that. Nobody's printing a new share, so that's always a good thing. I do believe that we have enough data for a final verdict. Timbercreek Financial has been a staple in my portfolio for some time. They have been a reliable dividend payer, and their overall price swings, well, they've been understandable. During the last bear market, their price certainly dropped big time. And to add insult to injury, they continue to fall with the aggressive rate hikes. In fact, they made it all the way down to $6.05. Once the interest rates stopped going up, they did recover back up to, well, $8.22 before real estate was impacted by reductions in immigration and, well, then those Trump tariffs almost immediately after that. Real estate is not expected to take a direct hit from the trade war, which is a plus for Timbercreek. However, the collateral hits could have a little bit of an impact for sure. With all of that being said, I do think they are going to be fine on the other side of this, and I do not think their price will drop too much further. I'd be surprised if we actually make it below $6. But what about the dividend? Yes, their current cash flow is making it appear to be unsustainable. However, I do think that is a wee bit premature. We should pay attention to their payout ratio through the following year. And yes, if it stays high, then there is more concern for sure. I do not think even in a worst case, they would even consider a cut anytime soon. This is a good stock, in my opinion, for an income investor for the steady dividends, and getting in while they are down gets you a very nice yield. For the dividend growth investors, this is also a good choice, as I do see a good amount of growth on the other side as this stock regains much of its value. That will make for some better total returns over the recovery. I am currently holding them in the 0 to 100K challenge for that. Well, for that recovery. I still have high expectations for this stock. If you are interested in Timbercreek Financial, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on some killer gold stocks. Thank you for watching, and I will see you in the next video.